My view has been for some time this thing that I said of we set the rates extremely high, highest in decades, and the way I think of what the rate is, we set a rate and then subtract off inflation. That tells you the real Fed funds rate. That's the thing that matters. That's the highest in a very long time, and as inflation has come down, before this cut, we set the rate high and held it there for more than a year as inflation came down. So we're tightening in real Fed funds terms every single meeting. By not cutting and going along with inflation, we're tightening. And so when inflation is coming in at the target and unemployment is where you want it, do you want to be the tightest in decades? That's gonna move you. If you're restrictive for too long, you're not gonna be at that sweet spot on the dual mandate for much longer. So that's why I think the cut of 50 basis points to start makes sense. It's the kind of thing where it is a demarcation that we're shifting back to a normal dual mandate mode where we're thinking about employment and inflation and out of what we have been for a year and a half, which is singularly and prioritizing the fight against inflation, which we had to. But make no doubt about it, we're hundreds of basis points above the neutral rate. And if you look at the statement of economic projections, which comes out once a quarter, and everybody on the FOMC says, what, in their personal opinion, what do they think will be appropriate over the next year and 2 years and 3 years? It's not just one cut. The important thing is what we opened with. Take the long arc. If conditions continue like this, there are a lot of cuts to come over the next 12 months. There's virtual unanimity about that. So whether the next one is 25 or 50 or 0 or whatever, my view is over the next 12 months, we have a long way to come down to get the interest rate to something like neutral to try to hold the conditions where they are.